It was one of crypto's biggest moments to date. But the Ethereum merge has come and gone, and everyone is asking a really important question. Now what? What does this mean for the future of the network and the price of ETH? And are there any risks ahead for Ethereum in the post-merge era? That's exactly what I'll be answering in my video today. So if you hold ETH or are considering doing so, then this is a video you cannot afford to miss. Last week, on Thursday at 6:40 AM UTC, Ethereum finally made the transition to proof of stake. It was a nail-biting moment that had everyone, including yours truly, on the edge of our seats. It was even more tense given that not long before, a few sync issues had been discovered on the final testnet. But as the block came and the code was pushed, there was a palpable sense of relief in the air. The price of ETH briefly shot up in a relief rally. However, this was short-lived. As the day progressed, it fell by almost 5%, as it turned out that this was indeed a sell the news type of event. But beyond that, there were a number of immediate questions raised by the transition. And one of the primary concerns that presented itself was one that many had argued could be a risk, including us here on this channel. This is the risk of validator centralization on the Ethereum network. Now, while miner centralization was always a concern, the extent of the centralization on the new proof-of-stake network is alarming. 42% of the network, in other words, was effectively within the control of these two entities. Now, the centralization of a supposedly decentralized network is, of course, a big no-no, but it's even more concerning at this particular time. That's because of the potential for regulatory capture of Ethereum. It's perhaps no coincidence that on the same day that the merge went ahead, Gary Gensler was up to his usual shenanigans on Capitol Hill. During testimony in front of US politicians, he said that cryptocurrencies that allowed users to, quote, stake their coins could be seen as securities. This assertion is based on that infamous fourth criterion of the Howey test, and argues that, quote, the investing public is anticipating profits based on the efforts of others. So, this threw up a lot of questions about how regulators are going to view proof-of-stake Ethereum. This is unfortunate given that a few weeks before the merge, it appeared likely that Bitcoin and Ethereum would be regulated in the future by the Commodity Futures Trading Commission, or CFTC, a regulatory body notably more enlightened about cryptocurrency than the SEC. As we know, a security designation means that this would place them back under the SEC's jurisdiction. Now, some seem to think that this could be nothing but FUD, which perhaps it is. But, as a thought experiment, if ETH was designated a security, could these validators be in breach of any securities laws? Let's not forget that Coinbase is based in the US, and most of the VCs that control LDO's supply are too. This simply shouldn't be an issue on a decentralized and permissionless network. Then, of course, you have all those concerns that came before the merge about the potential for censorship of transactions. This was all around the sanctioning of Tornado Cash. Now, I did a video about this in much more detail, which I'll leave in the description for you if you want all the ins and outs. The main concern here, though, was censorship at the protocol level. Would validators exclude all transactions involving Tornado Cash? As I said in the Ethereum video I released before the merge, no one is going to risk breaking sanctions, irrespective of where they are on the decentralization ideological spectrum. That said, Coinbase is fighting these sanctions with a lawsuit against the Treasury Department. Respect. Now, it's unlikely, though, that this lawsuit will bring any sort of clarity in the near term. And in the meantime, centralization questions will remain. Moreover, as these validators continue to stake and their rewards build up, their power in the staking contract will grow more disproportionate. Nothing can be withdrawn yet, and the functionality to do that will only come with the next upgrade. Which brings me neatly on to the next topic we need to examine. Some of the FUD that has surrounded the merge has been around the idea that we would see a flood of staked ETH hitting the market as validators look to sell. But, as I mentioned, this can only be done once the Shanghai upgrade is complete in about 6 months' time. Now, apart from allowing beacon chain withdrawals, the Shanghai upgrade will also introduce EIP 3540. I won't go into too many technical details here, but the core of this upgrade is that it will separate the code from the data, also known as EVM object format. There will also be changes that will potentially lower gas fees. This will be done by equalizing the block sizes and increasing the call data functionality of the block. Moving beyond Shanghai, though, the Ethereum devs have a whole host of upgrades on their roadmap. These all used to be a part of ETH 2.0, but they have now taken on some much more colourful names. The next stage in the roadmap is the Surge. This is the stage that will introduce sharding. Now, this is seen by many as the upgrade that will bring most of the scaling benefits to the Ethereum network. That's because it will see the majority of the network split across a number of different blockchains known as shard chains. Now, without getting too technical, this will allow computation to be done in parallel, as each of the individual shard chains will handle their own computations. These will then be settled on the main chain at a later stage. They would also enable those roll-up layer 2 solutions to be even cheaper and make nodes easier to operate, as they won't need to store the entire blockchain. When it comes to scalability, transaction throughput should increase exponentially with the number of shards. If we were to include layer 2 scaling benefits, then there are some estimates that we could see Ethereum handling up to 100,000 transactions per second. Now, in terms of timing, the surge could be expected next year, although there are no definite dates yet. Then, after the surge is complete, we'll have the Verge. This will bring with it the introduction of Verkle trees. Now, these are a powerful upgrade to Merkle trees, which will optimize data storage and node size, further helping with scaling capability. Next up after that will be the Purge, which will allow for the removal of spare historical data and the purging of irrelevant data. Essentially, it will streamline storage and further help to reduce network congestion. And then, the final step will be the Splurge. This is in fact a range of smaller, quote, miscellaneous upgrades that will ensure that the network is able to run smoothly while incorporating all those previous upgrades. So, there's no doubt a lot to look forward to from a development perspective. A process of constant evolution to move the Ethereum network to that long-envisioned goal of being a global, decentralized virtual computer. But in the immediate short term, recent events have a number of other implications for the network, and these relate to monetary economics. I've talked about the impact that the reduced block emission and fee burns will have on the ETH inflation schedule, otherwise known as the triple halving, on a number of occasions. Prior to the merge, there were only estimates as to the impact it would all have. But after a few days, we have a better picture. Hopping over to ultrasound.money, we can see exactly what has happened to the supply of ETH. It initially fell right after the merge, but has been climbing ever since. However, at the time of shooting this video, the supply growth was running at 0.16% per year. That's if we were to assume the current emission rate of 603,000 per year and a burn rate of 413,000 per year. Thankfully, this site has a handy feature that allows us to switch over to what the conditions would have been if we were still on the proof-of-work chain. In this case, the supply growth would have been 3.79% per year. So, based on those stats, the transition reduced the emission rate by 92%. If you run the numbers on that, it's almost a quadruple halving. And it's also incredibly close to no inflation and even deflation. That is the scenario that many ETH holders are looking at, which will make ETH ultra sound money. I should also note that the current Bitcoin inflation rate is 1.8%, although this will approach zero as it goes through future halvings. Now, how likely we are to approach ETH deflation depends on the total emission, which is driven by amount staked as well as the amount that's burned. The latter is, of course, driven by the number of transactions. This is something that is likely to increase, not only because of all the scaling benefits achieved through the numerous upgrades that I talked about earlier, but also because of utility demand. One of the primary use cases from this will be the need for stablecoin payments, which are growing at a rapid pace. A recent survey, for example, found that among businesses surveyed with annual income exceeding $1 billion, 85% said they are adopting crypto payments to find and gain new customers. You also have to factor in the scaling and efficiency gains that are likely to come because of the continued development of Layer 2 solutions. And, as mentioned before, sharding will only make the case for rollups that much more compelling. Now, all of this utility use, demand, combined with an increase in burns, decreased supply, means an asset that should be that much more valuable, holding all other things equal. Okay, so that's the monetary dynamics behind ETH's demand and supply drivers. In the long term, it should be price positive. However, once the Shanghai upgrade has been pushed, could this result in a flood of unstaked ETH hitting the market? Well, not quite. Firstly, there is the question around the initial deposits of the validators. If you'll recall, these were 32 ETH. Well, once Shanghai has been implemented and people can unstake this ETH, there will still be a process to handle the amount that can be unstaked in a given period. This is in order to ensure that there isn't that much of a change in the validator set in a given time. Obviously, that would be a risk to the network. As such, there will be, quote, a withdrawal queue, which will limit the rate of validator exits. This will be limited by protocol, whereby only 6 validators can exit per epoch. Now, just for reference, an epoch is every 6.4 minutes. So, if we were to assume 32 ETH exited per validator, that would amount to 192 ETH per 6.4 minutes, or roughly 43,200 ETH per day. Bear in mind that there's currently 14.5 million ETH being staked, so that would amount to just 0.3%, not a price-breaking amount by any means. Of course, the rate is adjusted based on the amount of ETH staked to continue ensuring security. So, that's the minimum staking amount. However, validators will still be able to withdraw any rewards that may have accrued since they started staking. Rewards that will have been accruing for over a year. That is a great deal of ETH that could hit the market. Well, that all depends on whether those validators will really want to sell. According to research from the Nansen analytics firm last week, 71% of those who have staked did so at a price higher than $1,700. In other words, they are currently at a loss, and it's likely to be worse now given the fact that ETH's price has fallen further since then. So the question inevitably becomes whether these holders will be so keen to dump their ETH that they'll do so even at a loss. This will only be the case if they were in desperate need for funds and willing to take the L. But this doesn't really make sense to me. That's because if there were ever a question about the need for liquidity, they wouldn't have locked it up for an uncertain period of time in the staking contract. According to more data from Nansen, quote, ETH millionaires and billionaires have consistently been stacking Ethereum since the beginning of this year, seemingly unfazed by volatile markets. Smart money seems to be scaling in again after a low in early to mid-June. So, the dreaded scenario of unstaked ETH crashing the price seems to be less likely. However, all of this assumes ETH hasn't become an even more compelling investment post-merge. Allow me to explain. The energy reduction that has been achieved by the move to proof of stake cannot be understated. The move to proof of stake has cut ETH energy use by 99.98% and carbon dioxide emissions by 99.992%. According to a new report from the Crypto Ratings Council, the entire Ethereum network now uses less CO2 than a few hundred US households. Now, I found this tweet particularly entertaining as it does a good job of visualizing exactly what the move to proof of stake means. When viewed in totality, the merge will reduce global energy consumption by 0.2%. Pretty crazy. All of this makes ETH a much more compelling investment for all those institutions that were put off by crypto mining's association with energy use. Now, yes, I know that a lot of this is FUD, and if you watch my recent video on the White House's Bitcoin mining report, you'll know why. But you cannot deny that the ESG investing narrative is a powerful force. So, could we see large ESG-centric firms like BlackRock upgrade ETH in their rating criteria? Could we see large pension funds using the ESG narrative as the green signal to buy, pun very much intended? Not only that, but should these investors decide to stake their ETH, they'll be earning passive income on the asset, similar to the way they view dividends for stocks when valuing discounted cash flows. Could Warren Buffett even crack out his calculator and run the numbers on ETH's long-term potential and present value? Well, who knows, but the point is that the investment case for ETH among more traditional investors has strengthened. It's not only ETH as an asset that will benefit from this green halo, though. You also have the demand for use of Ethereum's network. For example, if you'll recall, one of the main cases given against the adoption of NFTs was the crazy gas fees that were paid to mint and move them. Naturally, this also required a whole lot of energy. So, now that that energy use is minuscule, environmentally conscious artists, musicians, brands, and other potential NFT adopters can finally jump in. As NFT adoption increases, network use surges, which further increases demand for ETH and drives the burn. And, as an added plus, gamers won't get as salty about in-game NFTs as they won't have to compete with ETH miners for pricey GPUs. Win-win. Okay, time for some of my thoughts on the merge. And in case it wasn't obvious, these are purely my opinions and not investment or financial advice. This merge isn't just for show, you know. Now, there's no doubt that the Ethereum devs pulled off an incredible feat. As they termed it, it was analogous to changing a rocket ship's engine in mid-flight. There were many things that could have gone wrong, but didn't. I put that down to the meticulous planning that the devs went through, despite all the doubts that had been cast about their ability to succeed. Now, of course, this was a sell the news event, and some have been disappointed about the lack of fireworks on the day, but this was always to be expected. Scaling benefits will not come until the surge. Then we have the Verge, Purge, and Splurge still to look forward to. But at this very moment, the predicted monetary changes are having an impact on ETH supply, emissions have dropped considerably, and inflation is now minuscule. Now, while the impact of this won't be felt in the short term, it's something that is likely to play out in the longer run. It's that much more of a compelling investment based on this point alone. Then, of course, there's the green angle that comes with this upgrade. Institutional investors can finally invest in ETH and start staking now that questions around its environmental impact have been eliminated. The same can also be said for companies that want to consider NFT or stablecoin payment integrations. Now, all of this being said, centralization is a concern. A situation where the top 5 staking entities control 2/3 of the staked ETH isn't a great place to be. And this is even more so the case when you consider the fact that many of these validators are based in the United States. Whether they could be forced to comply with orders from the man is an important question. Then again, we also have to remember that with proof of work, mining pools also control a great deal of the hash power. Prior to the move to proof of stake, the top 3 Ethereum mining pools controlled 50% of the network's hash power. That aside, though, the question now shifts to how we can further decentralize the Ethereum network. The argument can be made that it's a lot easier to operate and run a validator than it is to crack out a GPU and start mining. There's no need for racks and racks of machines taking up your garage, empty rooms, or, large warehouse facility somewhere in Iceland. All you need is 32 ETH and a server. Moreover, with a proof-of-stake system, non-staking nodes have more power in keeping staking nodes in check as compared to keeping miners in check. This means that we can play our part in that decentralization by running a node. And if you happen to be lucky enough to have 32 ETH, then you should consider setting up a validator and doing so. I'll leave some guides in the description. Yes, it's a lot easier to stake on an exchange or through a liquid staking protocol, but that defeats the purpose of decentralization. Yet, if there's anything that the merge has taught me, it's that when the Ethereum community comes together, they can do great things. And that's it for my Ethereum video today, folks, but I would love to get some of your feedback now. So, where do you think ETH is heading? Bullish or bearish? Or do you have another layer 1 pick that you prefer? Let me know in the comments down below. And while you're down there, you can also find links to all the other places that you can follow me apart from YouTube. These include my Telegram, Twitter, TikTok, and Instagram. And, of course, the creme de la creme, my weekly newsletter. Here I share upcoming videos, market updates, and a breakdown of my personal portfolio. Also, if you're looking for some of the best discounts and promos in the space, then touch base with my deals page, discounts that only viewers of this channel get to enjoy. All of that which you shall seek is there at the tippy top of that description box. And finally, if you found this video fire, then fire up the likes. Don't forget to subscribe to make sure you're in line to receive my latest crypto vibes. Oh, and hit that bell as well. We don't want it to get lonely. That's it for today, my fellow crypto fans. Guy's gotta fly, so for now, it's goodbye.